Good evening, everyone. We're going to get started, so if you could take your seats, that would be terrific. I'm Eric Belsky. I'm the Managing Director of the Joint Center for Housing Studies of Harvard University, and I'd like to welcome all of you to the Graduate School of Design for the 13th Annual John T. Dunlop Lecture. The lecture is named after really a giant in many fields. John Dunlop was a giant within Harvard University. He was the dean of the Faculty of Arts and Sciences during the 1960s, as you all know, an interesting period to be the dean of an American university, an American college. He also, among many other things that he did while he was at Harvard, negotiated the first contract with Harvard's union. He was also a giant in the field of labor economics and a giant in public service. It's rare you can say this probably about anyone, but he advised every president from Franklin Delano Roosevelt all the way through to George W. Bush, Democrats, Republicans, all times, all periods. Also served as the Secretary of Labor in the Ford administration, and was very fundamental to the foundation of the Joint Center for Housing Studies, and really watched over the center over many years so that we could do the work that we've been doing now for more than 50 years. So it's great to be here to hear from our speaker tonight, who will be Senator Mel Martinez, who I'll introduce in just a moment, but also to honor John T. Dunlop, as I say, just an amazing person and someone we all who got to know him feel very privileged to have gotten to know him. I'm going to turn the podium over to a couple of people who are going to add their greetings to you all tonight. First is a good friend and colleague, Professor Tony Gomez Ibanez, who is the Derek Bach Professor of Urban Planning and Public Policy, holds joint appointment at the Harvard Kennedy School and the Graduate School of Design here at Harvard, and therefore, like the Joint Center, is a bridge between those schools. He's been a longtime friend of the Joint Center and a great colleague and friend to me and a great advisor to me. So with that, let me turn it over to Tony.
My job is a very brief one, just to welcome you to the Graduate School of Design on the part of the faculty and the students and others, and to thank the National Endowment for Housing and the Joint Center for Housing Studies for supporting the Dunlop Lecture, which has been running many years in his honor. As Eric said, John Dunlop was really a legendary professor. He used to run the university from a booth in the First House restaurant, a restaurant that's now been turned into a bank like so many other things in Harvard Square. But those of us who were young junior faculty at the time would get summons to have coffee at his booth and go there with terrified but emerge wiser and with all the more respect for him. But I think what really characterized him was that he was a bridge between the real world and academia, the world of practice. And he had a special love for the housing industry and the building trades unions. And it was for that reason that I think he became a leading figure in the founding and in the management of the Joint Center for Housing Studies. And I think the Joint Center for Housing Studies bears his mark as a bridge between academia and the real world of practice and industry. And it's been distinguished for its reports and research that are of great, held in great respect both by industry and by the academic community. So it's my honor to welcome you here, to attend the Dunlop Lecture, and to remember John in a brief way.
Tonight's event is also sponsored along with the Policy Advisory Board of the Joint Center for Housing Studies, many of whom are here tonight and who provide financial support to the center, through the National Housing Endowment, which is a housing endowment affiliated with the National Association of Home Builders. And to greet you tonight from the National Housing Endowment is one of their trustees, a former president of the National Association of Home Builders, and to me, a great friend and a great mentor, and we served together in the National Association of Home Builders many years ago. He was distinguished among all the staff at National Association of Home Builders, is a really beloved industry leader for the association. He has a very gentle manner, but a very effective style of getting things done. So it's a pleasure for me to welcome Roger Glunt to the podium. Thanks.
Thank you, Eric. Ladies and gentlemen, it's indeed my pleasure on behalf of the National Housing Endowment to welcome you to this lecture, the 13th annual John Dunlop Lecture. The Housing Endowment is very proud to partner with Harvard and the Joint Center in this lecture, and we are at the National Housing Endowment. Education is very important to us. We sponsor doctoral research. We fund lectures, conferences, and seminars. So it's important to us to be involved in education. I'd like to just tell you a little bit more about the National Housing Endowment. We were formed in 1988 as the philanthropic arm of the National Association of Home Builders, and over that period of time we've raised more than $23 million and have awarded grants in better than $11.5 million, and it's all for the purpose of bettering housing and bringing more qualified people into our industry, and we focus on education and training and research. Our current program is the HELP program. It's an acronym for Housing Education Leadership Program, and through this program we make awards to colleges and universities throughout the country to try to improve construction management and, again, bring more qualified people into our industry. The lecture tonight, as both the previous speakers have indicated, is to honor John Dunlop. John was a founding member of the National Housing Endowment, and on a personal note, I considered him a friend and a mentor and certainly an inspiration. He was a great man. And the lecture tonight that's co-sponsored by the Housing Endowment and Harvard and the Joint Center is to honor John's great commitment to housing. He was a great man, and one of his passions was housing. And over the years, these lectures have distinguished themselves by hosting leaders in housing. And tonight we're certainly very honored to have former Senator and HUD Secretary Mel Martinez to join our list of very distinguished lecturers. Before I sit down, I would like to acknowledge a couple of people who have made a special effort in behalf of the National Housing Endowment in the past year. The first being Isaac Heimbinder, who is a member of our Board of Trustees. Isaac has contributed to support this lecture tonight. And the second is Bernie Gleiberman, a member of the Policy Advisory Board, who provided support for the State of Nations Housing Report this past year. So to Isaac and Bernie, we say thank you. Please extend please accept my most sincere welcome from the National Housing Endowment to this great lecture.
So before I introduce our speaker, I do want to acknowledge one other person in the room, my great friend, longtime colleague, and the Director Emeritus of the Joint Center for Housing Studies, Nick Ritsinas. I think not a stranger probably to almost anyone in this room, but thank you, Nick, for joining us. Nick is working with Senator Martinez presently on a bipartisan housing policy commission, and therefore is continuing to do the great work of trying to reach common ground. Having heard all the wonderful things about John Dunlop and all the great stories I think we all have and could tell, we couldn't be more pleased tonight than to have Senator Mel Martinez as the 13th John Dunlop lecturer, because he really stands in those kinds of towering shoes in the way that I think John Dunlop did. So it's just wonderful to have the senator with us. Senator Martinez really has a remarkable personal story. He came to the United States as an immigrant under a humanitarian relief effort and really has lived the American dream from what were really humble beginnings. He has ascended the heights not only of government, as is obviously indicated by his title, but also the highest ranks of business as well, and has brought a balanced view to so many issues that's just so sorely wanted by so many people. I can tell you a little bit about Senator Martinez's career, but I think it's interesting to note that he's the first of, he has many firsts. He was the first Cuban American elected to the Senate. He was a senator from Florida from 2004 to 2010, a senator who went wanting to get things done, wanting to reach out and try to get the kinds of compromises that are necessary to actually do something in Washington and get legislation through. Viewed it as a period of public service where that was his primary goal. Immediately before that, he was the Secretary of the Department of Housing and Urban Development, and also spent time when he was a senator as the chair of the Republican Party and was the first Hispanic chair of a major political party. He currently serves now in business capacity as the chairman of the Southeast and Latin America for J.P. Morgan Chase, and is on the executive committee of J.P. Morgan Chase, and so has really now a unique kind of perch from both a public service perspective and a business perspective. But before he did all these things, he also spent 25 years as a practicing attorney in the Orlando area, had a number of local appointments. So here's a person who served in administration. He served in Congress as a senator. He plays a leading role in a major international, and especially for us, national bank, and a person who had experience in local government and in the private sector. And he brings really a unique blend of knowledge of housing and an understanding of what it takes, as I say, to get things done both in business and government. Now, I've given you the whole resume of Senator Martinez, but what the resume doesn't show is what I've come to know, which is that he is a true gentleman. And he represents all the things that people say we now clamor for in public life, and that is a civility to engage with issues, have strong convictions and passions, but a willingness to have open ears and really an open mind, and to try to find common ground to move the country forward. And he really is a very unique individual, humble, very effective, and we're very fortunate because he continues to play a leadership role within the housing field. He's on the board of Habitat for Humanity International, and as many of you know, our last speaker was a CEO of that terrific organization. But he's also currently serving as a co-chair of the Bipartisan Policy Center Housing Commission, which is an attempt to get people to come together in the spirit of bipartisanship to think about how the housing system ought to be reformed in the future. Now, being part of a commission that I'm advising, Nick Gritzinas is also very instrumental in, is an interesting process, to say the least, and it is a little bit of what the senator experienced in the Senate. Tonight, he gets to let his hair down and tell us what he thinks ought to happen in terms of housing policy and the housing recovery. And I think you'll see, because he's persuasive, many of these themes and elements are going to be reflected in the final report of this commission. He has enormous stature in the field, and you'll see in a moment we're in for a treat if someone has really thought deeply about these issues and cares about them. So with that, let me bring the senator to the podium.
Wow, Eric, I don't know if I can live up to all of that, but thank you very, very much. Very kind, and what an honor it is to be here tonight, and thank you for the invitation to deliver this very, very important lecture to the continuation of housing studies and the legacy of John Dunlop. And yeah, I'm immensely honored to be invited, and delighted to be here with people like Nick, who is such a good friend, and have known for a number of years. When I was at HUD, I needed advice, I would call Nick. And he always was willing to run to Washington and sit down and have a chat about things. Although, of course, those were in the heydays of housing. You know, things were going pretty good at the time. I had no idea we had problems, but anyway. But John Dunlop, I want to just take a moment to talk about that because in Eric's introduction, he touched on the issue of coming together and advising presidents. Can you imagine in today's climate a person who would advise presidents of both parties over a period of 4 or 5 decades? That is a unique trait, and I think is worthy of admiration, and I am just incredibly honored to be a part of this lecture series, to honor him and such a terrific American, and what a wonderful legacy he leaves behind. And we should follow his example. And let me also say, because I am in Massachusetts, and I think there's a Senate race going on here. I think I heard about that last night. Anyway, when I was running for the Senate, I thought the last person in the world I'll ever work with on anything is Ted Kennedy, because he's way to the left, I'm sort of to the right, and we won't find much to talk about or work on. And I must say that Senator Kennedy was someone that I came to know, respect, and admire greatly. And he was the rare kind of breed that would hold dearly to points of view, but yet had that ability to reach across the aisle and say, we've got to make a deal. And if we make a deal, it's not going to be all my way. It'll never work. And it cannot be all your way. So we have to find that way of reaching where we each have some give and take. And so I would say that while there may be a lot of differences in the way he and I approach some of the issues, that we did sit around the table and try to come together. And that's a rare trait and a rare quality. And it's an important one that I think, unfortunately, we're losing a great deal of that in our public discourse. So I hope as we go forward in this conversation tonight and as we talk about the future of housing, that we would have an opportunity to come together and come to the realization that we really have a shared destiny, and we have to find ways in which we can work together. So owning a home, one of the most fundamental aspirations of millions and millions of Americans, for many, the most critical investment that they will ever make in their lives. Homeownership has enabled millions of families to build up equity over time, which is usually translated into greater household wealth and more financial security. This is what we call the American dream. I remember when I was at HUD, I would talk to people about how homeownership could provide that home equity that would be enough to either improve the house, or it would be also a way of helping with a college education or help start a business. Well, those days are sadly not with us today, and we see a very different situation. So it's played a central role in my own personal journey. I can remember, I came from Cuba at a young age, and later was able to be reunited with my parents. And I can remember the great pride my father felt and would talk about when we finally bought a home in America, and it was a very modest place, but it was ours. And he felt like we finally owned something that made us be really a part of this great society and this great American story. And so homeownership really is a little more than just the brick and mortar that puts it together. And I know in my own family life that we not only owned a home that my wife Kitty and I raised 3 children in, but it was also the composite of being a part of a community. So with the collapse of the housing market and the economic hardships that have followed, many understandably challenging the fundamental assumptions and reassessing the value and the role of homeownership in today's society. Have we overemphasized homeownership as a means to acquire wealth? When is homeownership appropriate for a family, and when is it not? Are we doing enough to support affordable rental housing? And are federal resources properly allocated between ownership and rental? These are just some of the questions that policymakers today are facing, and I know that we will continue to look to the Joint Center for guidance in some of these very, very difficult issues. No doubt today we're living through one of the most difficult economic periods in our nation's history. High unemployment, sluggish growth, and an unsustainable federal debt burden are problems that continue to challenge our nation's policymakers. And few would have predicted that after 6 years of decline, the U.S. housing market would still be struggling to find its footing, although I think we all would acknowledge that the last few weeks and perhaps the last couple of months have been more encouraging, and so we hope for that. And so we've witnessed some hopeful signs, and sales of new and existing homes have increased, and house prices are beginning to rise in some parts of the country. New multifamily construction is also on the upswing after dropping to historic lows during the height of the recession. These positive developments cannot obscure the fact that there's still some sobering facts out there. A staggering 11 million households today are underwater on their mortgages, and more than 1.2 million families are somewhere in the foreclosure process. In many regions of the country, the large number of distressed properties will continue to dampen the housing market prospects for the foreseeable future, Florida being one of them. For minorities, the situation is particularly severe. Among African Americans and Hispanics, homeownership levels have dropped dramatically in just 3 years. I can remember that one of my goals when I came to be Secretary of Housing and Urban Development, and Nick may recall this as I testified before the Senate for my confirmation, I said that one of my goals was to continue to strive to achieve more homeownership for all Americans, but particularly for minority Americans. And we reached numbers that were unheard of before, but now we see a different story. In 2010, the rate of black homeownership was 28 percentage points lower than the white homeownership rate, a wider gap than in 1990 or in the year 2000. The rate among Hispanics has also dropped to pre-bubble levels as more than 1.3 million Hispanic families have lost their homes. In fact, the Center for Responsible Lending found that during the recent crisis, borrowers of color were more than twice as likely to lose their homes to foreclosure as white households. There are numbers of reasons for this disparity, but it's clear that practices like reverse redlining and steering minority families into risky mortgages and loans with the high prepayment penalties were major factors leading to higher default rates within the Hispanic and African American communities. What is so disheartening is that many of those families who did default had good credit, a good income, and everything else required to qualify for a traditional long-term fixed-rate loan, but instead were steered into exotic interest variable costly mortgages that they did not fully understand nor could they afford. In hindsight, it's obvious that there were insufficient controls in place to prevent these pernicious practices from occurring. It also appears that stronger financial education or even mandatory home ownership counseling, at least for the first-time home buyers, may have helped people avoid these traps. Whatever our political views may be, I think we can all agree that this exploitation of the American dream must never happen again. As much as housing contributed to our current economic difficulties, it can also help to build a new area of prosperity. A stable and strong housing market that avoids the mistakes of the past will directly translate into more jobs, higher income families, and a more vibrant economy. Over the past several years, policymakers have paid far too little attention to this critical connection between a return to economic prosperity and the housing market. In many respects, restoring our nation's housing market has been treated as an afterthought rather than as a necessary precondition for economic recovery. I think if we look back in our history, no economic recovery has occurred without being led by housing. Once the smoke has settled from the November elections, it is my hope that Republicans and Democrats will join together and make housing a top national priority in full recognition of its ultimate link to America's economic renewal. There are 4 specific but interrelated areas of housing policy that I believe deserve immediate attention. So overcoming the scarcity of credit in today's mortgage market, mitigating the impact of the foreclosure crisis, establishing a clear vision for the future of the housing finance system, and responding to the rising demand for rental housing. So let me take a moment and share some thoughts on each of these issues. Today, young families who avoided the storm want to own a home and are ready to take advantage of the lowest home prices and interest rates that we've seen in our lifetime, but they either cannot afford or cannot qualify on the new standards required to enter the mortgage marketplace. If you think about it, in the span of less than 72 months, we went from one bad extreme to the other. It wasn't that long ago that a person could walk into a bank, provide no proof of income, no proof of assets, a couple of pieces of identification, and walk out with a mortgage. How about today? A credit-worthy couple can walk into a bank with a substantial down payment, provide enough paperwork to pass an FBI background check or perhaps become an American citizen like I had to do, and walk away with a rejection stamp on their mortgage application. Mortgage lending has declined in 2011 to the lowest level in 16 years. Sure, banks are not making the loans they traditionally made because they do not want to repeat past mistakes. The bursting of the housing bubble hit their balance sheets hard, and many private financial institutions are naturally cautious about the approach they're taking now to underwriting. But it's also true that the uncertainty inspired by the future prospect of an array of new, potentially restrictive federal banking rules are having a profoundly negative impact on credit availability today and I think they're stalling the housing market's recovery. If these rules remain in their current form as originally proposed, the effect on credit availability could be devastating. Ironically, the source of many of the new rules is the Dodd-Frank legislation, whose aim is to protect consumers from the past failures of the mortgage market. Much attention is rightly focused on the pending qualified mortgage or QM rule. Dodd-Frank requires mortgage lenders to prove that they have tested borrowers' ability to know that they have the ability to repay the loan by considering factors such as past credit history, income, employment status, and other financial resources. Now, you wouldn't think you need a law to get a bank to do that, but anyway, that's where we've come to. So, in theory, this approach is intended to ensure banks actually take a realistic and holistic look at borrowers, and that borrowers have a clear picture of the mortgage that they're committing to. And on paper, the motivations behind the QM make sense. But as is the case with most federal regulations, it's the fine print that really counts. And on the proposed rule now under review by the newly created Consumer Financial Protection Bureau, a lender may presume that a loan has met the ability to repay test if it is a QM. So, how a qualified mortgage or QM is defined becomes absolutely critical. A definition that is too narrow will mean that most lenders will be cautious in their mortgage practices, lending only to the most creditworthy borrowers out of fear that they will violate the ability to repay standard. The likely result will be that millions of otherwise qualified consumers will be shut out of the mortgage market altogether. On the other hand, a sufficiently broad definition of QM, and one that provides some certainty that the ability to repay standard has been met, will help ensure that the mortgage credit flows to a more expansive group of borrowers, since lenders will have a greater assurance that they're operating within the bounds of the law. The concerns about QM rule are amplified by a battery of financial penalties, fees, and other damages the rule would impose on lenders who fail to meet the ability to repay standard. A 3-year statute of limitations during which defaulting borrowers can bring lawsuits also provides a concern, providing yet another reason for banks to hold back credit as they extend the exposure that they may have to litigation, costly litigation, of course, as it always is the case. So the question really is, how will QM be drawn? We're waiting for that regulation to come down. The overriding imperative here is to strike a right balance, protect the consumers from the abusive lending practices that we've seen all too recently, while ensuring that mortgage credit continues to flow to those who need and want it and who can bear that financial obligation. There's other pending regulations that have a similar market-damaging potential. The Qualified Residential Mortgage, which deals, or the QRM, another product of Dodd-Frank, which requires issuers of mortgage-backed securities, MBSs, to retain 5% of the risk on the securitizations, unless the underlying loans qualify as QRM. Again, the motivations are exemplary, and again, it's in the details that great concern arises. So how does the proposed rule define QRM? For purchases of a mortgage with a maximum loan value ratio of 80%, meaning that only those mortgages with a 20% down payment can qualify for QRM status. For straight refinances, the loan-to-value ratio is even tougher, 75%. So, of course, these requirements are completely out of sync with the realities of today's market, where most borrowers are unable to make a 20% down payment or have 25% equity in their homes. So while these non-QM borrowers might still be able to obtain a mortgage, they would do so at much higher interest rates. So policymakers should also continue to closely examine the possible consequences of other well-intended federal initiatives like HUD's proposed disparate impact rule under the Fair Housing Act. For example, if the CFPB embraces the narrow definition of QM, will banks that adopt more conservative lending practices in response to that find themselves subject to fair housing litigation as a result of underwriting policies that may have a disparate impact on minority groups? So you see, it's a kind of a confluence of regulations, all well-intended, but having a very difficult time in making good sense for those that are trying to make the loans. So in addition, we need a much clearer picture of how a more stringent capital requirements of Basel III will affect mortgage costs. I'm not going to get into Basel III because you're probably already nodding asleep, and I won't get there, but that is something else that's impacting the banking world today. To me, what is most troubling is the disconnect between idea and execution, fearing Washington have the full picture of how all of these complex rules and requirements will interact with one another. Nor do we have a good handle on what their combined impact may be on the willingness of banks, especially community banks, to extend mortgage credit. Yet such an undertaking is critical to reducing uncertainty and advancing policies that will spur the housing market's recovery. So I have a suggestion for our next president, just as John Dunlop would have done, whether it's Governor Romney or President Obama. After the inauguration festivities and all the parties have ended, I would suggest issuing an executive order directing the Department of the Treasury, in coordination with federal other banking agencies, to inventory all of these new rules and regulations. Direct agencies to assess the likely impact of these rules on mortgage lending with a focus on affordability and accessibility, and then ask Treasury to report back to the President within 60 days, not only with his assessment, but also with a concrete action plan to get mortgage credit flowing again. Another area, of course, that continues to require the substantial attention of policymakers is the problem of foreclosed and distressed properties. Economists predict U.S. foreclosures will continue to mount, especially now that the banks and state attorneys general have settled the many questions regarding foreclosure practices. With many of these questions having been settled, financial institutions will be pressed to clear their backlog of troubled properties. Over the past few years, the Obama administration has unleashed a number of foreclosure prevention and relief programs: HARP, HAMP first, then HARP, HARP 2, the FHA Streamlined Refinance Program, and the HFA Hardest Hit Fund. All of them well-intended, all of them have had some positive results, but all have fallen short of expectation, and of course none has really completely solved the problem. So recognizing that there are no magic remedies or quick fixes, I'm going to suggest a few ideas that might help some families. So idea number one, why not consider utilizing interest deferment as a way to improve the long-term performance of deeply underwater mortgages? To help reduce the number of strategic defaults by borrowers who still have financial wherewithal to continue making mortgage payments, Fannie and Freddie could offer an interest deferment when the mortgage far exceeds the home value. And over a defined period of time, perhaps as much as 5 years, the borrower would continue to pay the full amount due on the mortgage, but the payment would be applied solely to reduce principal. In other words, any interest payment due would be temporarily deferred. Fannie and Freddie would no doubt incur some cost as they assume responsibility for making interest payments to their investors, but over the long term, they may realize substantial benefits as borrowers continue to make timely payment on principal and fewer mortgages will go into default. To ensure that borrowers bear some cost, the decision to defer interest should be linked to a commitment by the borrower to share with Fannie and Freddie, and hence with the taxpayers, any appreciation in the home's value once it is sold. Another suggestion seeks to protect local home values in neighborhoods hit hardest by foreclosure. This is an increasingly important issue as the government looks to bulk sales of foreclosed properties as a means to clear local housing markets. And you know, we've seen this in Florida also often. The act of foreclosure puts a tremendous dent on home values and can dramatically reduce the price for which it can be sold. In fact, a recent MIT and Harvard study concluded that foreclosures reduces the value of a house by some 27%. So today, sale of foreclosed properties continue to be recorded as comparable home valuations or comps. In the appraisal of non-distressed properties located nearby, they all become infected by the same problem. This practice depresses home values in the surrounding neighborhood and impacts the ability of potential home buyers to secure adequate financing. I have seen this in Florida. I've seen it in neighborhoods. I've talked to appraisers. I've talked to realtors who just say it is impossible to maintain home prices when these foreclosed properties are lumped together and they're not the same. An arm's length sale between two parties that neither one has to sell nor the other one to buy is not the same as a foreclosed sale in terms of what the appropriate value of the home was at the time of sale. So my suggestion would be to help remedy this problem that Fannie and Freddie and FHA could simply refuse to accept the sales of foreclosed homes as valid comps, forcing an upward reappraisal of the non-distressed homes. In those markets where the volume of home sales is modest, thereby requiring the use of foreclosed homes as comps, an alternative approach might involve simply bumping up the sales of valued as foreclosed homes by an appropriate amount. And finally, why not encourage Fannie, Freddie, and FHA to adjust their underwriting standards for well-qualified, self-employed individuals who are seeking to benefit from today's historically low interest rates and prices as they seek to refinance. As underwriting standards have grown increasingly tighter, many self-employed individuals are facing real difficulty to meet the income documentation criteria necessary for a refinance. People who work for themselves often receive compensation on a regular basis from their customers and are unable to present a history of pay stubs to a potential mortgage lender as a way of documenting past income. While the total number of self-employed dropped during the recession, still a large number of people, today 14.5 million Americans, are self-employed, working either in incorporated and unincorporated businesses. So without increasing risk, Fannie and Freddie and the FHA could make adjustments to their underwriting criteria that acknowledge the unique income documentation challenges faced by the self-employed. So each of these proposals can be implemented administratively without the need for congressional action, and better yet, none requires the appropriation of any additional public funds, which, is hard to do these days, to appropriate more funds. So let me add that policymakers should be wary of big splash solutions like principal write-downs. In recent months, some in Congress have made a very public push for the FHFA, the Federal Housing Finance Agency, to approve selective principal write-downs for underwater mortgages held by Fannie and Freddie. Principal reduction paid for by the taxpayers is a bad idea on many levels. It's expensive, difficult to justify, creates an atmosphere of unfairness, and puts a chill on future mortgage contracts. And that's not just my arguments. That's exactly what Secretary of the Treasury Geithner said to a congressional oversight panel back in 2009. And I give high praise to FHFA's acting director, Ed DeMarco, for standing firm on the question of principal reduction. He's taken a lot of heat, but I believe he's right. So over the longer term, our country must redesign and rebuild its broken system of housing finance. In many respects, this system functions as the motherboard for all housing in the United States, linking secondary market investors from all over the world to homeowners in Lincoln, Nebraska or Tallahassee, Florida. And this is done through a complex circuitry of mortgage originators, servicers, securitizers, and guarantors. And it can be a powerful machine that produces wonderful benefits. But before we look to the future of housing finance, we should reflect on what lessons we can draw from the past. And so I'll give you a couple of my conclusions. First, if it seems too good to be true, it probably is. My mother always said that. At the height of the housing boom, many borrowers and lenders convinced themselves that home prices were heading in one direction and only in one direction. Many borrowers, of course, took on mortgages that they could not hope to service over the long term with the expectation that they would be able to accumulate home equity and then refinance into a more affordable loan. And this worked fine for a while, but when the music stopped, the fact is that a lot of people found themselves in trouble. So we cannot make this mistake again, and any future system of housing finance must be resilient enough to weather the inevitable periods when the market takes a drop, even if it is a big drop. Second, prudent underwriting is absolutely critical. In fact, it is the foundation for a sound system of housing finance. I'm still a big believer in the power of home ownership to help lift families into the middle class. But during the height of the housing boom, many lenders abandoned prudent underwriting under a guise of promoting home ownership. And yes, in some instances, federal housing policy encouraged this practice. And then finally, protecting the interest of the taxpayers must always be paramount. The taxpayers have paid dearly for the government conservatorship of Fannie and Freddie, and to date is some $150 million with little chance of recovery. So business models in which gains are privatized while risks are socialized really just do not work and should not be repeated. So now let me talk about the Bipartisan Policy Center, where we're endeavoring to develop a vision for a new system of housing finance. And the commission was launched late last year with the generous financial support of the MacArthur Foundation. And I'm joined there by former HUD Secretary Henry Cisneros and former Senators George Mitchell and Kit Bond. And we are, the four of us, are the co-chairs of the commission, where we're joined by 21 other members from both political parties who bring to the table a wide variety of experience. Ken Colton is here tonight, and he is one of the real knowledgeable people in the business of housing, and of course Nick as well. And although the commission has not issued its final report and our deliberations continue, there appears to be broad agreement on some fundamental issues. So like other observers, the commission believes the federal government is playing far too large a role in our nation's housing finance system. Yes, greater federal intervention in the housing market was necessary when the market began to collapse, But the dominant position held by the federal government today is unsustainable. Figuring out how to encourage private capital to assume a greater share of the credit risk in housing finance is a continuing focus of our work. Consider these facts. In 2010, purely private sector mortgage originations constituted only 12% of all originations, compared with 53% 10 years earlier in the year 2000. Loans guaranteed by FHA and the Department of Veterans Affairs combined with Fannie and Freddie conforming loans were a staggering 88% of all originations in 2010. In 2011, securities backed by Fannie, Freddie, and Ginnie Mae constituted 97% of the mortgage-backed securities market, with non-agency funds less than 3%. So getting private capital off the sidelines and back into the game is imperative. The direction we must take is clear. Fannie and Freddie should unwind in an orderly fashion over a period of time, and we must establish the conditions to allow the private sector to step in and fill the gap as the government footprint becomes ever smaller. Transitioning to this new, less government-centered system will take time. The housing market remains very fragile, and precipitous action could easily push the market into a state of further disarray. But in the short term, there are a few steps that we can take to help us move to our goal of greater private sector involvement. Congress, for example, should lower the loan limits for Fannie and Freddie and FHA to allow larger loans to flow to the private sector. As it has started to do, the FHFA should also gradually increase the guarantee fees that Fannie and Freddie charge lenders, moving the government pricing structure closer to the level that one might expect if a mortgage credit risk were borne solely by the private capital. And FHFA should continue shrinking the size of the Fannie and Freddie investment portfolios. To me, one of the most egregious things that occurred during the heydays was the portfolio of Fannie and Freddie grew to incredible proportions, doubling down on the bet, if you will. While the Commission envisions a much more limited role in housing finance, it does see FHA, VA, and Ginnie Mae as vital sources of liquidity for lower to moderate income borrowers and for first-time homebuyers. We also recognize that some level of government intervention is necessary to ensure a continuous supply of mortgage credit to the middle of the market, currently served by Fannie and Freddie. The key is to structure the government's role in a way that is narrowly circumscribed taxpayer risk while promoting stability and affordability. So any guarantees that are offered by the government should be explicit, appropriately priced over catastrophic declines in the housing market, and triggered only after private capital has assumed the predominant share of any loss. So the government, in other words, should function solely as an insurance backstop of last resort. It's been more than 4 years since the government first nationalized Fannie and Freddie, and yet Washington still has no clear plan for the future of housing finance. So next year, Democrats and Republicans must begin to bridge their differences, find common ground, and make housing finance reform the kind of national priority it deserves to be. And here's one that hopes that tomorrow night, as we discuss the economy and the presidential debate, that maybe one of the questions will be about housing, will be about Fannie and Freddie and their future and how that might be resolved. Because honestly, I'll tell you, if it isn't part of the presidential debate, it becomes really difficult for housing to be the priority that it ought to be. So as we redesign our housing finance system, we must not forget the multifamily side of the ledger. In fact, multifamily may be the headline story of this decade. There are a number of factors that are now converging to put enormous pressure on the multifamily demand. The first factor is obvious. Homeownership rate has declined by nearly 4 percentage points since it peaked in 2004. Today's homeownership rate is 65.5%, which is near a 15-year low. Assuming that a significant number of today's distressed borrowers will default on their mortgages, we can assume that today's homeownership rate will drop even further, meaning that more and more families will look to multifamily or rental housing as an alternative. Demographic factors are also in play. As the Joint Center has amply shown, the echo boomers, those 62 million young Americans born between 81 and 95, are now beginning to strike out on their own. As they establish their own households for the first time, many will seek rental housing, often in urban settings where the supply of affordable rentals is limited. The number is huge. We're talking about 5 to 6 million new potential renters. Our society is becoming more ethnically and racially diverse. Hispanics, we will be 25% of the population by the middle of the century. I won't be one of them, but that's what the figures will say. And while homeownership is an important aspiration for many minority families, some will simply not have the resources to make homeownership work, particularly as underwriting standards become more stringent. All these factors are already being felt by many large metropolitan areas as vacancy rates are dropping and renters are increasing. As I see it, and the key question here is whether the private market will respond to the increased demand in larger metro areas, or there will be a sufficient number of new units. Otherwise, rental costs will be even more unaffordable for a large number of households. New multifamily construction is cranking up. The market senses an opportunity. The question really is, will it be enough? So policymakers should consider whether there are ways we can better leverage private sector resources with improvements to valuable programs like the low-income housing tax credit, with more than 100,000 units of multifamily stock being lost each year to obsolescence. We should also assess whether our existing tax policies sufficiently support the preservation of existing units and the construction of new ones. Above all else, we need to have a strong housing finance system that helps meet the capital needs of the multifamily sector. The current finance system has not served this segment of the market so well, particularly the small rental units of 20 units and less. And the fact is that the system has ignored the small multifamily, which may be an important component of our future housing stock. So let me conclude by saying that the challenges in today's housing are so numerous, and at times it may even seem overwhelming. In fact, I think much of Washington's inaction on housing stems from the very complexity of the problems themselves. It's quite natural to convince ourselves that we should put these problems off to another day when the timing might be better or the conditions better suited for change. But of course, as we know, those days will never come. So although all of us here today disagree on some specifics of what housing policies we should pursue, I think we all agree that the housing is just too important to be put off for another day. For the millions of families struggling to stay in their homes, for the millions of young adults who cannot get a mortgage or find affordable rental housing, for our nation's economy whose growth depends so much on a vibrant and stable housing sector, next year must be the year that housing returns to prominence on the national public policy stage. So with that, I say thank you for the opportunity to present this to you, and I hope that we can continue the conversation. Thank you very much. Thank you.
Senator Martinez has agreed to take some questions, and before he does, I want to say I'm looking forward to sitting out on your porch in Florida in 2050, so I'm not here in New England when you invite me to celebrate the great housing finance system that we rebuilt together.
Right. Come in the winter.
Come in the winter, and that's my plan. But the senator laid out a lot of, I think, meaty suggestions about how we can practically respond to the housing crisis. Talked a lot about the policies that could be pursued. I want to take the first privilege of the first question, just say, sitting where you do in J.P. Morgan Chase and looking at what's happened, and you raised the concern about both access and affordability to credit. How does the world look right now for a private lender in this marketplace, and what do you think it will take to be able to get back to a level of credit that isn't one of those two extremes that you spoke about?
As I touched on, I think the QM rules, clarifying the QM rules is going to be a big deal, and I think how that comes out is really, really important. But let me say beyond that, we at J.P. Morgan Chase, we're a big bank. And what we're finding is that a lot of this regulatory soup that has been created can be much more easily weathered by us than it can by small local lenders. And so what I think we're finding is a problem, not so much with the big banks, but a continuing problem and probably a growing problem at the small lender level, at the community bank level, that are so important for that small developer to put a few houses together or do a small apartment building. And they really do a tremendous amount of the local financing. You know, at one time in my life, I was on the board of a couple of community banks, and that was all the lending in Florida that we did, really. It was real estate lending. And with these rules of the game being so complex, with the regulatory schemes being so challenging, I'm not so sure that the availability of credit at the local level from the smaller banks is going to be there. I think from our standpoint at the large banks, I think we're prepared to move forward and go forward, and we'll have the wherewithal to weather the storm or weather the regulatory maze. But I do believe that there's still, by the way, some uncertainty brought on by the threat and the existence of litigation in this arena, which continues to be a problem. Today, you know, the headlines invite that conversation. So we still have a lot of work to do, and I just don't think that there's any easy answer. Hey, Tom, how are you? Yes, nice to see you.
First of all, you should know that there are at least a few of us in this audience who wish you were on that stage tomorrow night in that debate.
Well, thank you.
Given how extraordinarily well Fannie and Freddie did with multifamily as opposed to single family, where I think the delinquency rate was something less than 1%.
Right.
Is the commission giving any thought to the notion of a separate solution for multifamily?
I think the answer is absolutely, and we're cognizant of that, and I think that, number one, maintaining the Fannie and Freddie in the playing field for multifamily is vital and critical, and I think there's no doubt that at least I feel very strongly about that, and I think others do as well. And I think continuing to look at the problem, we do understand there's a huge difference in the way they perform in one as well as the other. Having said that, I still think there's a strong commitment, at least by myself. I'll speak just for me at the moment, and Nick and Ken might have to back me up here one way or the other. But I do believe that the evolution out of Fannie and Freddie as government entities is something that many of us would like to see. And whether that happens, I mean, it's not, I don't think anybody's crazy enough to want to do it overnight, but I think moving that into more of a private-oriented operation, as I said, with some perhaps federal backstop, is really the way that I think we should approach it. But whatever entity emerges, this idea that you could have private gain and socialize the losses as we did in this go-around just cannot be repeated, To me, that's fundamental. Questions? Yeah.
Are you looking at the issue of the 30-year mortgage?
Sure. I mean, I think that that is very much ingrained in the in the American system and in the American dream. And so, I think that increasingly we need to find ways in which the securitizing market comes back, because I think it's vital to the whole liquidity of mortgage finance. And so I think all of that is tied together. But I do believe that part of the problem this past crisis was the fact that so many mortgages were crazy arms that people didn't fully understand or have any idea how they were going to impact them a few years or months even down the road. So I think that the significant down payment, what that should be, ought to be a part of the future, obviously. I think that, I've sinned. I will be the first to admit. I was at HUD, and, we were pushing hard for the down payment initiative. I can't remember now what the law was called, but you try to forget these things. But the fact is that you could not give someone that has no skin in the game every opportunity to buy a home. Perhaps people should wait a little bit before they buy their home, and perhaps some down payment by the individual, not just provided by financing on top of financing, or even grants or government assistance, really should not be a part of the home ownership scheme. I think we've got to have a more sound system, but the 30-year mortgage, I think, is still the bedrock of where we are. Oh, sure.
How much concern do you have about the current state of the FHA and the life market?
I think well, look, and I'm not an expert on FHA. There's others in the room that are. In fact, Nick used to run it. But, my take is that as long as you can provide the premium support to FHA, that it's going to remain solvent. Now, can it be the sole source of housing finance that it's been recently? No. And so market share has to shrink dramatically. But at the current time, and I know from time to time this issue arises, at the current time I don't think we're in danger of that fund running into trouble. But I also don't think that what FHA is doing today is sustainable. So I think it has to evolve out of the current role that it's playing into a more limited role. Yes, in the back.
Thanks. I was evicted from my apartment here in Cambridge as a result of a mortgage foreclosure some years ago, and as a result ended up in public housing here in Cambridge. where I have ended up being the president of the tenant council at a major public housing development. And I'm certainly no specialist in sort of big macro housing policy, but I am a bit of a specialist in what it's like to live in public housing and deal with some of the issues at that level. And I'd be interested in hearing what you have to say about the public housing side of it in terms of a couple of things. There's an uneasiness as there's more and more private financing. There's an uneasiness about the low income tax credit approach and other forms of private financing in a couple of ways. One is, again, in the light of what you said, this can look like to some of us like the private sector benefiting once again in ways that may not seem equitable. And it also seems to be coming as a result of the defunding of what some would argue is a more efficient way of funding public housing. And so, without going into too much more, I wonder if you could speak to some of those issues.
Well, if you are truly in public housing, and I guess it would be the Cambridge Housing Authority, there's no private funding or private financing there. It is all government. HUD provides all of the funding.
Actually, that's no longer the case.
It is not.
Yeah, what's been going on over some years now, and it may have to do with it's being a moving to work agency. I'm not sure how relevant that is, but there's actually very
private money in it.
Yeah.
Okay. Well, and that, by the way, part of that is because there's a desire to modernize some public housing, which has been so dilapidated and so run down over the years. And so because the government is not able to provide the funding, then private sector money has to come in.
Not able to or not willing to?
Well, that's a different debate, and we could go around and around on that. But, watch the presidential debate tomorrow night. They might get into that a little bit. So I think, frankly, from an acknowledgement on either side of the political aisle, that when you see the debt structure of our government today, there really isn't a lot of money in the government today to do things that have been done in the past. So I think we have to look to the future with a different set of eyes, and I think we have to look for more public-private partnerships, and I think those are the ones that I think are going to provide a lot of the stimulus and financing for things to be done. So I think the answers of the last 50 years are not the answer of the next 10. I think we're going to have to look for different solutions until we get our financial house in order as a government. And part of that is, a combination of, Simpson Bowles, frankly, I'm a fan of, and while I wouldn't ascribe to every single dot that I and comma in that, I think is a vehicle by which we can begin to get our house in order. A combination of restructuring of our tax system with additional revenues, as well as some look at our entitlement programs and how we structure them for the future. So, anyway. Yes. Well, I think there is going to be a big bad tax debate in our country, and I think it's going to begin, sometime after the first of the year. I think there'll be some talk in the lame duck session of the Congress, but I think after that you'll see a very vibrant debate, and I think that there will be a very strong effort for significant tax reform. That will have probably most everything on the table, including the mortgage interest deduction, the low-interest housing income housing tax credit, and perhaps new ideas as well. But all of these issues, frankly, there'll be a tremendous, I think, debate on the role of government in a number of areas, including housing. So now, what my forecast is, this was just about housing tonight, so I'm not going to go into tax policy, but difficult to predict an outcome. It really depends tremendously on the election in terms of who controls. I think the House will be in Republican hands. Who controls the Senate is still somewhat in the balance, although today I would say most likely it will be a Democrat Senate, and then the White House. So I think we may end up with the very same format that we've got now. That's one, that will lead to certain outcomes. If it's different than that, it may be slightly different outcomes. But regardless, I think there'll be a very vigorous debate in Washington on tax reform.
Let me thank you for the terrific presentation and taking questions, and say to have a vice chairman of a large part of J.P. Morgan Chase standing up for the small community banks, and a former chairman of the Republican Party standing up for Senator Kennedy speaks volumes to why it's so interesting to have someone like Senator Martinez come and share his views on housing. So thank you so much for that.
Thank you. Thanks.
Thanks again.
My pleasure. Thank you.